So this is Friday, June 30th, and we're going to look at the S&P 500 because the fuel gauge today around lunchtime has finally gotten above 65. In fact, it got above 60 yesterday. 60 is often a level I talk about as being kind of a threshold, which in the past has been the most significant with regard to producing or predicting future significant positive returns. So we got above that level yesterday. In fact, we got there in spite of what is really not that significant, a pullback, nothing in the same scale as this. This was a one-day move. But that one-day decline, this pullback didn't even raise the gauges this much. So just to look at it historically, you can see now we're at this level here, above 60 yesterday and this 68.5. And that is the first time we've been above 60 since April, when we're going through this entire kind of consolidation period. So let's break it down and look at it by component. So I've broken it here. You can see the bond component, interest rate component, is in red. And you can see how volatile it has been. And that's because the bond market has had no consistent trend and has been prone to rallies followed by steep declines. And so it hasn't sustained a high kind of positive momentum level for some time. Now this is when bonds were going down. So fear itself is comparatively high. These are not really high levels by historical standards, but they're high relative to where they can be, and they're back to where we were in May. So the problem in May was that we had fear at a reasonable level, but we had no bond help, and so we had no chance to really get this index up materially. So it didn't really predict much of a rally off of this bottom. But now with bonds up here, they are combining with the fear level to give us an aggregate reading which is attractive. If we go to look at bonds, this is why they've been so inconsistent. You see them rising and then giving it back, rising and giving it back, and so on. This is the problem we have looking forward towards the end of next week. If bonds don't begin to rally and recover from this decline, then that bond contribution that we're getting now will go away, it'll evaporate. And so the gauge will fall back down to these rather neutral, uninteresting kind of 30-something levels. And if fear declines more, we could end up back in the kind of low 20s, teens. So we have to watch this rather carefully. Bonds should be responding better than they have been. They've had enough reasons, they've had a significant number of reasons to rally, including a major oil price decline. But the dollar is the problem here. And so this amount of dollar weakness is hurting bonds. And if that persists, it will also hurt equities.